From a 10,000-foot view, ESG is ultimately important because it has a significant positive impact on fundamental business issues relevant to the long-term success of any company across industries. These business issues include a company's approach to reducing risk, identifying and capitalizing on market opportunities, the quality of their corporate reputation, and aspects of their intrinsic value, like culture, employee engagement, and their overall approach to human capital management. Now let's break down each issue and examine how ESG impacts them. Corporate reputation. The way a corporation manages and communicates about ESG issues signals to investors, customers, and other stakeholders their awareness of the risks and opportunities of changing economic, social, and environmental conditions. ESG can enhance a company's license to operate, making it easier to accomplish their business objectives and respond to crisis scenarios with key stakeholder groups. Referring to the Facebook example from 2018, their billions of market losses were due to their tarnished reputation in managing cybersecurity attacks. Risk reduction. ESG supports identification of both immediate and long-term risks, depending on the industry and business model. Material and labor availability, evolving regulations, and supply chain disruptions are examples of potential ESG-related risks. For example, a food production company in the Western U.S. is dependent on a large local labor force to produce and distribute their products. If wildfires, as a result of intensifying climate change impacts, damages the public transportation infrastructure that the labor force depends on to get to work, this is a real risk to the company's business continuity. Opportunity management. Shifting market and non-market conditions, in addition to greater stakeholder engagement and stewardship, can expose unmet needs for new products and services, unserved or underserved customer bases, and vital strategic relationships for addressing ESG issues of mutual interest or concern. For example, Unilever's ESG efforts in emerging markets have resulted in greater profitability and market penetration, as well as positive societal impact. By providing a wide range of training and support to independent stores, kiosks, and micro-businesses in emerging markets, Unilever is accessing new customer bases and generating revenue streams through localized distribution networks that only local vendors could tap into previously. Culture and intrinsic value. A company's ESG maturity is a good indicator of their commitment to building a high-performing, purpose-driven workforce and inclusive culture. Since intrinsic value is a forward-looking measure of company worth based on a company's strategies and its ability to execute them, a more engaged workforce is crucial. In a nutshell, integrating ESG factors into valuation allows for greater insight into intangible factors like culture, talent recruitment and retention, operational excellence, and risk that can improve investment outcomes. For example, a company with an authoritative leadership philosophy and hierarchical culture may dissuade entry-level employees from speaking up if they see and hear something of potential risk or opportunity. A company with an inclusive culture and systems for expressing concern, sharing insights, could avoid a risk or capitalize on a unique opportunity by systematically encouraging open dialogue and communication at every level of the organization. The collective impacts of ESG on these standard business issues leads to outcomes essential to the long-term viability of the firm and the risk and reward ratios of a given fund. Chapter 2, ESG Factors. Now that we have a big picture idea of how ESG supports a company's risk management and business continuity capabilities, let's dive into the issues themselves. We'll be going through key environmental, social, and governance issues that have a material impact on the widest spectrum of industries. First, let's dive into the most prominent environmental issues to be aware of. Although not exhaustive, as environmental issues include a wide range of concepts like deforestation, biodiversity health, climate change, natural resource scarcity, and all pollution and waste are financially material to a wide range of industries. In turn, significant issues to be aware of from a perspective of making capital allocation decisions. Let's unpack these a bit. Climate change. Climate change is the ultimate risk accelerant, exacerbating both conventional and ESG-related risks. Rising temperatures, more frequent and intense weather events, including storms, floods, droughts, and wildfires, all significant risks across industries in the economy. If you are a financial analyst for a REIT, for example, climate change presents a portfolio risk to all commercial real estate, and risk assessment should account for how climate change may impact the asset itself, as well as the associated insurance and maintenance costs. Natural resource scarcity. Due to changing environmental conditions, the stewardship of scarce natural resources like water and soil are increasingly important to more industries and vital to the welfare of all stakeholder groups. If you're an analyst conducting due diligence on a multinational food company, it's their approach to managing the risks associated with depleting global water supplies and increasing drought that would be a direct material risk to account for. Pollution and waste. Pollution and waste can have far-reaching risks on companies and portfolios. Pollution and waste can cause serious reputational and reputational risks to a business, like plastic waste or food waste, and can influence product R&D, retail expectations, and consumer requirements. Additionally, pollution can cause health concerns that influence license to operate and can trigger serious legal and regulatory ramifications. For example, beaches littered with plastic waste from the bottled beverage industry will influence local tourism, travel, and leisure industries due to the reduced appeal of these destinations. Analysts responsible for making capital allocation decisions should absolutely be monitoring a company's management of pollution and waste. Environmental issues may not impact a company or portfolio directly, but it will most definitely have a material impact on key stakeholders like customers, consumers, or suppliers. We know that certain industries will have greater risk exposure to environmental issues than others. But as a financial analyst, the single most important environmental issue you need to be aware of is climate change. Climate change presents a wide range of direct and indirect risks to companies. The easiest way to think about them is in terms of three types of risks: physical, transition, and human risk. Physical risks. Physical risks are exactly what they sound like. Climate change can physically impact company assets and surrounding infrastructure, and the assets and infrastructure of key stakeholders, like customers and suppliers. These changes will also influence supply and demand as resource needs change amidst these conditions. Think about coastal communities, how rising tides and flooding will impact local distribution infrastructure and real estate values. Transition risks. Transition risks are a bit more abstract than physical risks. They include shifts in climate and environmental policy, associated technologies, and changing consumer preferences. For example, a multinational invests in a brand new fleet of diesel trucks without following evolving federal legislation and local legislation in key markets. When carbon taxes are passed in key markets, these assets could now be considered sunk costs and/or liabilities. Human risks. Severe weather, rising temperatures, natural resource scarcity, all will result in certain regions being unlivable. Mass migration due to the adverse living conditions could risk the viability of certain geographic markets, local labor force availability, and required infrastructure. Although described separately, the reality is these risks are often interconnected and can exacerbate the impacts of one another. Take the coastal community example. If local infrastructure is damaged by the physical impacts of climate change, local labor forces may be forced to migrate inland due to the economic and human health risks associated with the damage. Local businesses that rely on this local labor force will suffer due to the human resource challenges. Let's look at social factors. There are a wide range of additional social factors to consider, including community engagement and responsible sourcing. The following issues represent significant risks to a wide range of industries, and that's why we've chosen to focus on them specifically. There are also increasing calls for greater disclosure in these spaces by regulatory bodies. Let's examine the risks associated with these factors. Human capital management and welfare. Shortages of skilled labor, uneven wage growth, technology, and evolving market trends are transforming the talent market, making human capital management a key issue. The world's largest investors, like BlackRock, are demanding more comprehensive disclosures on how companies are building the skills, knowledge, and collective capacity of their workforce to improve bottom-line outcomes. This issue will be specifically relevant to less labor-intensive industries, like high-tech, finance, and consulting. In August 2020, the SEC deemed human capital management as a significant material risk, and greater disclosure requirements will soon be a part of standard financial reporting. Product and service safety. Product safety and supply chain oversight is a significant risk to corporate reputation, customer retention, and reparation costs, not to mention regulatory fines. The direct cost for food product safety recalls, for example, is estimated to be approximately $10 million per recall. Human rights and labor management. Investor interest in human rights and labor management has grown in recent years due to some high-profile human rights abuses in brand-name company supply chains. When Nike was accused in the 1990s of knowingly using forced labor in Asia to produce their products, this controversy led to significant college athletic team boycotts, institutional customer losses, and a wide range of consumer protests, all damaging corporate reputation and the bottom line. Labor protests are also a growing material issue due to the risks it poses to business continuity. Whether domestically or abroad, the way in which a company manages its relationship with labor is important to assess when gauging a company, industry, or specific fund's risk exposure. Let's break down the risks and opportunities these social factors can create for a given company. Employees. A mature ESG presence has a direct impact on employee recruitment, engagement, and retention, in addition to greater productivity and performance, all positively influencing the bottom line. A lack of attention to employee investment, engagement, and general welfare can result in significant losses. Annual research from Gallup consistently points to employee engagement's direct impact on corporate profitability and economic stability. Research shows engaged employees result in 21% greater profitability. Disengaged employees cost companies between $450 and $550 billion annually due to absenteeism, burnout, negative health consequences. Customers. Conventional customer preferences, including convenience and price, are shifting to include concepts like environmental sustainability, social impact, and customer experience. A company's ESG maturity can signal to you as an analyst that they are deeply engaged with their customers' evolving needs and unique pressures. Using the Nike labor scandal example, athletic institutional customers were pressured by their constituents to cut business ties with Nike, resulting in revenue loss and loss of key advertising opportunities. On the flip side, using the Unilever example, they were able to access unserved customer bases by supporting the welfare of local shopkeepers selling Unilever products. Communities. The welfare of the communities that grow necessary materials, house assets, and production sites, and supply labor are all inextricably linked to the welfare of company interests. Improved relationships with local communities also enhance the company's license to operate. As an analyst, the financial and in-kind contributions to community causes and the extent of their engagement on community issues can provide insight into how corporations will manage the ESG issues that threaten both the company and the local community. Governance, or the G in ESG, covers a wide range of issues that can also be considered environmental or social concerns, depending on how a company, investor, or entity categorizes it. For example, supply chain management touches upon environmental and social issues, yet the management of a supply chain is ultimately dictated by those in positions of senior leadership. Let's go through some of the more dominant governance issues you should be aware of. Board quality, diversity, and effectiveness. The qualifications, accountability measures, and overall approach to counseling management to execute on multi-year strategies, including the integration of ESG factors into risk management and business planning, are key governance concepts. As large enterprises serve diverse markets, board diversity supports the successful engagement of diverse customer bases. For example, as companies enter emerging markets, a homogeneous board of directors will most likely engage in groupthink, reducing innovation and the ability to comprehend the needs and opportunities within diverse customer bases. Investors are increasingly looking at DEI as a critical benchmark and are looking for more comprehensive execution of DEI strategies. Reporting, transparency, business ethics. The comprehensiveness, the accuracy, and the consistency of ESG reporting disclosures are essential to both investor confidence and valuations, in addition to consumer and stakeholder trust. Heightened public scrutiny in corporate supply chains and social media have made transparency the new normal for both consumer-facing and B2B businesses. As consumers increasingly desire information on product sourcing, production, and labor, a company withholding this information will lose these customers. Investors will also make consequential assumptions about a company's management quality and intrinsic value when limited product or company information is publicly available. As an analyst, the extent of their disclosures and reporting should indicate the extent of their thinking around these issues. The leading and most credible disclosure frameworks include the industry-specific standards from their Sustainable Accounting Standards Board, SASB, and the cross-industry recommendations laid out by the Task Force for Carbon-Related Financial Disclosures, TCFD. The Global Reporting Initiative, or GRI, is another globally recognized and used framework for disclosing progress on ESG issues and complements SASB and TCFD. Executive compensation, long-termism, and ESG integration. As an analyst, if you see an executive compensation structure tied to environmental and social benchmarks and an ESG committee at the board level, you can be sure they are fully integrating these issues into their enterprise risk management system and long-term planning. ESG integration, or the process of systematically integrating ESG issues into daily business operations, is the single most important insight to deliver as a financial analyst. If a company does not have ESG as part of its enterprise approach to governance, it's likely they aren't fully assessing their risk exposure to these issues. A company's overall approach to governance, regardless of which category issues are placed in, can either enhance the following essential business outcomes or damage them. Stakeholder trust and license to operate. Consumer trust in corporations and institutions in general are at historic lows. B2B customers are now accountable for the behaviors of their supply chain partners. Employees no longer spend an entire career at a single company. Enhanced governance directly impacts the trust necessary for stakeholder confidence and license to operate. Back to that Nike controversy, their lack of accountability and due diligence regarding who they contract with led to institutional customer losses, consumer boycotts, and significant investor concerns about their license to operate both domestically and abroad. Enhanced risk management. ESG integration provides greater sensitivity to changing market and non-market conditions that could negatively impact business continuity, including stakeholder opposition, boycotts, or government fines and litigation. Long-term value creation. Integrating ESG factors into enterprise risk management and corporate strategy supports the organizational adaptability and resilience required to adjust to shifting economic, environmental, and social conditions. This supports identifying opportunities for long-term value creation by identifying new markets, customers, and unmet needs. For example, Unilever generates more than half their sales from emerging markets, selling personal care, sanitation products to middle-class populations. Their existing distribution network and local infrastructure enabled Unilever to access a completely new segment of low-income customers with a product and price point that improved customer outcomes and corporate profitability.